All right. Good morning, everybody. Can somebody give me a comment in the chat if you can hear me? I just want to make sure my audio is working correctly. Hear you. Perfect. Thank you. All right, cool. So good morning. Want to get started today. We're going to talk a little bit about taxes today, making more money, paying less in taxes. So we always hear tax the rich, right? Whenever they want to raise taxes or this or that, it's always about tax the rich. And something that's very important to remember. And also real quick, can you see my screen, the make more money, the slide? Perfect. Thank you. All right, cool. So here's what's important to remember. It's important to remember that the tax laws are a series of incentives, and it's a series of incentives that the government gives you in order for us to do what the government wants us to do. So reducing our tax liabilities is oftentimes doing the things the government wants us to do with our money to be able to pay less taxes. And typically that evolves around creating jobs or providing affordable housing. So there's one line that says essentially all income is taxable unless we say it isn't. That means the government's saying that, right? So what we have to do in our job is to figure out what we need to do to make an expense deductible under the law, because everything we want to do is going to be legal, of course, and we want to do these things that absolutely fit into the law. So the question I want you to ask yourselves is, what if we could deduct it all? So what if we can make every dollar we spend deductible? What if we could be deducting 20 to 50% more of what our expenses than we are currently deducting now? And so what we're going to do today is talk about legally how we can make those deductions. And moving into that, so start asking yourself, one, what if I can make every single dollar I spend deductible? And instead of asking, is it deductible, start asking, how can I make it deductible? Right. And this is why it's important to work with a CPA as well that really knows what they're doing, because CPAs are oftentimes a lot like what you call maybe real estate agents, right? There are some that are practitioners and there are some that are professionals. So getting somebody that really knows the law and that keeps up with the tax guidelines and really knows how to maximize every single deduction, a lot of which we're going to talk about today, but having somebody that's very knowledgeable and well-versed in this is super, super important. So let's take a look at this. How we make our money is important. Now, there's 4 ways we earn money. And this is from Robert Kiyosaki's cash flow quadrant. But there are 4 ways we make money. Let me get this out of the way if I can. And 4 ways we make money. One is as an employee. One is in self-employed. One is as a big business owner. And the other one's as a professional investor. Now, these are 4 ways we're going to focus on because how we expense is deductible depends on how we make money. And if you're making money as an employee, there are certain deductions available to employees that aren't available to self-employed people or big business or investors. And there are a few of those, that are some that are just because you're an individual, they're available to everybody. So looking at this in this cash flow quadrant, employee, self-employed, business owner, investor. Now, the challenge with this is, let's say as an employee, we have a job, meaning we're going to work for someone and we're receiving a paycheck. Now, with that, we're limited on the deductions we have because we're W-2. Government takes their money first, we get what's left over. Now, as self-employed, as a real estate agent, you're self-employed. Now, a challenge with being self-employed is now we also have self-employment tax to tack onto our normal income. So if we're not knowledgeable on how to offset that, we could be paying, if we're in the top tax bracket, we could be giving as much as 60% of our money away. Opening up a business. Now, each of you have a business in a sense, because you are in real estate, you're self-employed, but now also we're taking on staff, we're taking on office space. Well, because we're taking that on and employing people and adding jobs, we get a 21% corporate tax break. And if we go to be an investor where we're investing in real estate, what happens there is we can offset all of our income through some things we're going to talk about today. So let's start with personal deductions. Now, with a personal deduction, there aren't really very many personal deductions. Right. So with personal deductions, here's what we have to think about. We have to think about different behaviors mean that we get different results, and different behaviors create different results. So we like to say that if you want to change your tax, you need to change your facts. And here's why we're going to talk about deductions. We're going to focus on how do I make it deductible? And is it not, if it isn't deductible, how can we make it? right? So think about this for a moment. Here's some rules around business expense. Excuse me, I'm getting out of hand here. So sorry, personal deductions. So with personal deductions, there aren't a whole lot. Now, children are a personal deduction, so you can go have more children. That's a way to make one deduction. But another way are just simple things here. 401k. This is the most commonly used deduction that people can do. A simple IRA, a Roth IRA, a traditional IRA, a SEP IRA. Here is the challenge with these deductions. Now, one of the biggest challenges is that, and one of the most ones is 401k, but really this is deferment. It's not really a deduction. We're deferring tax until a later day. So today what we want to focus more on is how do we not only defer, but how do we just eliminate completely? So with the 401k, right now in 2022, you can put away $20,500. Now, if you have a 401k, most likely you have an employer match as well. It's a smart thing to do. And you're reducing your tax liabilities today, but you're deferring it for a later day down the road. The same is true with the simple IRA. You can put $14,000 a year away in the simple this year. Next year it goes up to $15,500. Again, you're deferring tax. Roth IRA. Now, Roth IRA is going to accrue. You can put $6,000 a year away today, or if you're 50 or older, you can put $7,000 a year away. Now, a Roth IRA is going to accrue tax-free because what's happening is you're paying money on the tax today, and then all of your money that accumulates and grows over the next 10, 20, 30, 50 years is growing and accumulating tax-free and compounding tax-free. And again, now you're generating compound interest, and that money will be tax-free at some point, but you're paying tax on the money today. So in a sense, it's not even deferment. You're not even getting the deduction either. You're just paying the tax, putting the money in. Same thing with traditional. It's deferment. It operates very similar to the Roth IRA, except you're deferring all of the tax on that money. The SEP IRA is another one. So here's something I would challenge each of you. If you don't have a tax account or a retirement account, you should look at these. A SEP IRA, if you're a single agent, a SEP IRA is something to look at if you're making a high income, because you can put away $61,000 and defer all of that income. So let's just say you made $70,000 and you put 61. I know this isn't a realistic equation, but let's just say $71,000 you made, you put $61,000 into your SEP IRA, you would only pay income tax on that $10,000. So you're deferring all of that and you're going to pay taxes down the road. Now, this is a great way. All of these are great ways to build wealth. And here's a challenge, something I want you to think about. With deferment of tax, in 30 years, we don't know what the tax brackets are going to be. Maybe they're 70%. Like taxes back in the day, I think it was in the 80s or something, anything over $1 million was taxed at 90%. So we don't know the taxes 30 years from now or 40 years from now might be 10%. We have no idea. But what we do know are what the taxes are today. And what I would challenge you with is just because this isn't a way to get a big tax deduction and you're deferring tax for a later day, I would recommend you get one of these set up and start looking into it and start investing in it. And this is pretty simple stuff. And if you have interest in this, we can talk more about it. It's very simple to set these accounts up on your own through Charles Schwab or Vanguard and invest this money in index funds, which generally generate about a 10% return annually over the last 20 years. So you can generate a really good return compounding by doing this. So just some things to think about there. Now, next thing we're going to step into is business expense rules. So with the business expense rule, this is how we make our deductions. We have to think about, one, is this expense that I'm making, it must have a business purpose. Is the expense I'm making, like if I go out and buy toilet paper, can I expense it? Well, it depends. Are you buying it for your office? Well, then maybe. Right? It has to have a business purpose. Is it ordinary? It must be ordinary, meaning it's an ordinary expense within your business. Is it necessary? Is it necessary for my business to grow, to profit, to continue to scale? And this is the most important one, it has to be documented. We have to document. So if we're making expense, and credit card statements are not, in the eye of the IRS, credit card statements are not documentation. You have to scan in your receipts, keep your receipts. It's good to have credit card statements, of course, but if you get audited, you must know you have documentation is very important. So keep these 4 things in mind, because these are 4 things we're going to talk a lot about today, but it must be a business purpose. It must be ordinary, it must be necessary, and it must have documentation. And if you have questions as we're going along here, drop them in the chat and happy to answer. So first tax rule we're going to dive into. This is one, the Augusta rule. So this is section 280. It's the Augusta rule. So it's known by the IRS as section 280A, and it's commonly known as the Augusta rule. Now, what this allows people to do is it allows homeowners to rent their home out for up to 14 days per year without needing to report the rental income of on their individual tax return. So the way this was created, it was originally created by the residents of Augusta, Georgia. So remember the Augusta National? What they would do is the golf tournament, they would rent out their homes to attendees of the annual Masters golf tournament. And then the Augusta rule applies to any taxpayer who owns a home in the United States, and provided that your home is not your primary place of business. So you can't rent out your business, but you can rent out your home. What happened is all of these people, wealthy people, they got together and said, you know what, we're making this income. We're renting out our homes to all these golfers and all these residents. We don't want to pay taxes on that money. So they created a tax rule. That's something else that's very important, is that tax laws are written by wealthy people to avoid having to pay tax. So that's when they say tax the rich. It's kind of funny in a sense, because tax laws are written by wealthy people to not have to legally pay taxes. So how does it work for the homeowner? So as long as you're the homeowner and it's not your primary place of business, you can rent out your home for up to 14 days and not report that income on your individual tax return. Now, the rent charge must be reasonable and in line with the rental markets. So meaning that, you know, if you're charging $1,000 a night to rent out your home and there's a hotel down the street that's just as nice and it's $200, that might not be considered reasonable. So homeowners, though, can rent their houses to individuals looking for vacation opportunities, or they can rent their houses to a business owner who intends to use it for business purpose. So think about this for a moment. If you're a business owner and you don't use your home as your primary place of business, you're employing the Augusta rule can be an effective strategy for moving income away from your business and shifting it into your personal income where there would be no tax consequence. Now, for example, let's just say, you as a business owner, you host a meeting with your board of directors. So under the Augusta rule, your business can pay you a reasonable amount to rent your house and conduct a once per month meeting. So provided that it doesn't exceed 14 days and the rent has to be reasonable. But think about this. If you have a team meeting, you have a team annual meeting, or excuse me, a monthly meeting with your team, and you were going to go rent out a place at the Marriott, and you wanted them to provide AV equipment and food and all of that, how much would that cost? Would it be $1,000? Could it be $2,000? Whatever that is, if you can do that 14 times a year, all of a sudden now you might have a $20,000 or $30,000 or even more as your team grows and the company gets bigger. If you're hosting this at your home, you might be able to get thousands and thousands of dollars of tax-free income that your business is paying you as an individual with no tax consequence. So a couple of things that are important to remember here. Is it necessary? Is it ordinary? Right? And we have to document it. So make sure that we're doing those things. And if we are, this is a fantastic way. Even if you rent your house out to a company that comes into town, right, and you're renting your home out like a hotel, you could do 14 days of that and offset all of that income and pay zero tax on it. Now, you have to have documentation to support your claim that this was a business deduction, critical to prove the rent, that it's critical to prove the rent was reasonable. And you could do things like print off rental quotes for hotels in the area. So make sure this is documented, though. This is a really, really effective way. Hosting business meetings at your home is a very effective way to offset income tax. So next one. Interested to see if anybody knew about that one or not. It's one that a lot of people don't know about, but it's extremely effective and it works really, really well. Employ your children is the next one. So you can employ your children. Now, hiring your children is a great tax strategy. And if you hire your children as employees to do legitimate work in your business, you can deduct their salaries from your business income as a business expense. Now, also, if your child is under 18, you won't have to withhold it or pay any FICA, Social Security, Medicare, any of that, or tax on the salary, subject to a couple of exceptions. So these rules are going to allow you to shift part of your business income from your own tax bracket to your child's tax bracket, which will be much lower than yours, or maybe even nothing. So this can result in a substantial tax savings. So what you can do is your child will have to pay taxes on the salary you pay them only to the extent it exceeds the standard deduction amount for the year. So what that means is that if you pay your child $12,950 per year as a single taxpayer, they don't have to pay any income tax on that. So there's zero federal income tax on $12,950 per year. So now what you can do is hire your child, employ your child to come do work for you. I'll give you an example. I do a mastermind group, and one of the guys has his children come and pass out flyers at the event and help out with the event. So what he does is he pays his kids each $12,950 per year. It goes into their own checking account. They have a custodial checking account set up. And then from there, he's able to use that money to pay for things like their school, pay for things like their textbooks, pay for things like their dance or their soccer or all of these things. So these kids, also you could set up a custodial Roth IRA for your child and start maxing that out at $6,000 a year, $6,500 a year next year, and start creating massive amounts of wealth for your children. So this is a simple way too to employ your children. Now, again, they have to work and you have to be able to prove that they're doing some things in your business. So think about however old your children are, what can they be doing? What type of work can they be doing to help in your business? Stuffing envelopes, I don't know, printing things off, filing stuff, like what can they be doing? Now, a couple of things to caution you on. The IRS is well aware of the tax benefits of hiring a child. So it's on the lookout for taxpayers who are claiming benefit without really having their children work in their business. Now, if the IRS concludes that your children aren't really working, you could get in some trouble. So you have to be able to prove it. And also, what's the age? Now, you're going to get, what's the age a child can start working in your business? You're going to get different answers from different accountants. I don't have any children, so I don't get to use this, unfortunately. But if I ever do, I will. But what's the age? Some might say 7, some say 8, some say 9, some say 10. But what's important to know is that really, what my accountant says is that you can use your baby as a baby model in your business, posting social media, using your baby in advertisements, using your baby on social media posts, using your baby as a baby model, and that can justify compensating your child at any age, starting from the day they're born. Something to think about. This is definitely a really, really cool tax savings. If you have more than one child too, it's a way to offset quite a bit of taxes. And like I said, like what my friend does, their kids then pay for a lot of their own expenses through using tax-free money. So a couple of things are your child must be an employee of your company. They must work. The work must be ordinary and necessary for your business. And they must be paid for the actual services they perform. So you can't just give them money and have them not do things. So you have to make sure you document this, right? So then too, like how young is too young, right? So depending upon what their job is and what they're doing for your business, that age can vary quite a bit. A lot of people say 7 is the acceptable age, but other accountants will say less if you do things and you document the correct way and you're actually using, let's say, your baby in your social media posting and advertising. Well, then you can do that. Now, what you should also do is keep track of the hours that your child is working, because that's going to be extremely important. But think about how many children you have right now, and could this be an effective strategy to employ right away to start saving money? So questions, again, if you have questions on this stuff, drop them in. I'm trying to figure out where there we go. Okay, cool. All right, next one. Cost segregation. So this is one with owning real estate. And this is one of the best tax advantages that people don't often know about when owning real estate. So cost segregation. What a cost segregation study is a cost segregation study is going to dissect the various components of a property and determine how you can compartmentalize assets and improvements into different classes of depreciation. So a typical accountant will tell you that you can depreciate a property over 27.5 years for residential and 39 years for commercial. Now, of that, 20% of that is the land value in the eyes of the IRS. And that's not depreciable. Land doesn't depreciate in the eyes of the IRS. 80% would be the building. So a cost segregation is going to break this up. And what a cost segregation is going to do is it's going to say, instead of looking at 80-20, we're going to take the 20% land, right, which we can't do anything with because it doesn't depreciate. But what we're going to do is compartmentalize the other 80%. And the way we're going to do that is we're going to take land improvements. Now, land improvements are things like maybe like a driveway, or maybe if it's a commercial building, a parking lot, or lighting, or we're going to take land improvements and depreciate that over a parking lot, like if you have a multifamily, you have parking pads in the back, garages, stuff like that on it, that could be considered land improvements. And what a cost segregation study is going to do is take the land improvements And they're saying that you can depreciate this over 15 years. Now, you can take equipment in the property. So equipment in the property, like the HVAC, like the electrical, the lighting, the plumbing, the appliances, everything like that, all of the equipment, and we can depreciate that over the course of 5 years. And then the building itself, the structure itself, is over 27.5 years, or 39 if it's commercial. So investors can also take bonus depreciation on all land improvements and equipment for 1 year, accelerating the entirety of the amount of depreciation against 1 year of taxable income. So I'm going to show you an example here on how this works. Oops, getting ahead of myself here. Now, let's just say on the standard deduction, on a property, if I were to purchase a multifamily in January 1st, say, for $700,000. Now, using the straight line method of depreciation, what I would do is, let's suppose I purchased it for 700 grand, right, on January 1st, and the land's worth 100,000, say, in the eyes of the IRS, and the improvements to the property are worth 600,000. January 1st is the date I purchased the investment property, so it's considered in place and service and until it's fully occupied by the tenants when you close, right? So the useful life of my investment property is 27.5 years. Now, based on the above here, the information here, the annual depreciation expense for my investment property is $21,818 per year. So the way I want to look at that is because what I'm doing is I'm basing that on $600,000 of real estate improvements and then just dividing that. So I'm dividing that over 27.5 years. Now let's just say the property brings in 30 grand in income. I can offset my $21,818 in depreciation and only pay income tax on the $81.82. So see right here, assume the property generates 30,000 per year income, 30 grand minus my annual depreciation over 27.5 years, which is $21,818, provides me with $8,181.82 in taxable income. Now that's cool, right? But let's look if we get a cost segregation. So remember that number. I'm deducting $21,818, right? Every single year over 27.5 years. Now, if I do a cost segregation study, and keep in mind, a cost segregation study does cost money. What they're doing is we're paying an accountant, it costs a few $1,000s. We're paying an accountant and an engineer to come into the property and say, okay, essentially, this building will not last 27.5 years. The contents of this building and the land improvements aren't going to last 27.5 years. So we're going to accelerate the depreciation of the property. Now, let's take the same exact property we paid $700,000 for, 100 of which is attributed to land. So as you recall, under the tax code, land is not depreciable. But what I want to do now with the cost segregation study is it's going to say that we're going to classify $100,000 of the land as land improvements. Okay, so that's depreciable over 15 years. It's going to take the building contents and the equipment inside the building and estimate it at $75,000 as equipment, depreciable over 75 or 5 years. And in addition to that, it's going to take the accelerated depreciation in the form of bonus depreciation. And I can take 100% depreciation for land improvements and equipment during the first year of depreciation. So some of this gets complex, I get it. We can go into some different scenarios down the road. But what this is going to do is my depreciation expense, by doing this, I can depreciate this property in year one for $212,122. So look here, I took my purchase price of 700 grand, my land value, my land improvements. My engineer and architect went in and said land improvements of $100,000. So now I'm going to be able to deduct $6,677 of that in year one. I'm going to take my equipment a deduction of $75,000 over 5 years. That's 15 grand a year one. My building, I'm going to depreciate over 27.5 years. And you can see my building value is going down because I'm decreasing between land improvements and equipment. So that's going down, but that gives me $15,451. Now I get a bonus depreciation incentive of 100% by adding my land improvements and my equipment in year one, which gives me my 100,000 plus my 75 for equipment. That gives me $175,000 bonus depreciation deduction. Add that into my depreciation, I'm at 212,000. So look at the difference there. It's 10x compared to what we were doing with standard depreciation. This is a massive, massive tax savings in owning real estate that a lot of people don't use, because so many people just use the straight line deduction of deducting it like the normal what most accountants will tell you. This is what my accountants, when I first started buying real estate back in the day, the first few accountants I used over the early years back then told me to do it the straight line way. I was leaving tens of thousands of dollars in tax savings on the table until I learned how to do cost segregation studies. So very important that you look into this and that you have an accountant that's knowledgeable with this. If you talk to your accountant and say, listen, I'm buying real estate and I'm looking to do a cost segregation study, or I own some real estate, I want to look into a cost segregation study, and they don't know what it is, or they say, don't do that, you need to be talking to a different accountant, because this is a legal way to depreciate rapidly your real estate. Now, the key to this, though, is once you do this, don't sell your properties, because you could potentially have a penalty and owe lots of money. So these are rental properties. You don't do this on flip properties. You don't do this on like your primary residency. But these are for income producing properties, commercial or residential, that you are going to buy and hold, and you intend to hold for a long time. That's really how you accrue wealth in real estate too, is you have to buy and hold. Flipping and all that, you can make quick money and you pay income tax on that money. With this strategy, you can basically never pay income tax and offset your deductions really for as long as you want. Now, here's the thing too, there's carry forward deduction too. So let's just say you have a $212,000 depreciation deduction here and your income, say $100,000. Well, you can carry forward that additional $112,000 and use that in a later year to offset income for the future as well. So when you look at it, I think they just released Donald Trump's tax returns, and he shows losses, a lot of losses on his tax returns. What Donald Trump does really well is he legally uses the tax strategies and the tax loopholes or the tax laws to offset his taxes, because he owns so much real estate. He's depreciating properties like this, and he's offsetting his income tax and carrying forward income tax. So essentially, he's never paying income tax, or he's paying a very, very, very small amount of income tax on a great deal of wealth. That's why he shows so many losses on his tax returns. It's because he's buying and owning so much property that he's carrying forward losses. So something to think about there. Extremely effective tax strategy. If you guys have interest in this, we can go deeper into this at some point. But this is a great way as you want to start buying real estate and buying rental properties to look at this. Now, something else I will note is that there's a certain price per home where this doesn't really make sense. So until you start getting to about 100,000, owning a property about 100,000 or more, anything under that, it doesn't make a whole lot of sense to spend the money, because you're not going to tax save that much. So like I own a lot of properties that are lower end price points. It doesn't really make a whole lot of sense. So keep that in mind. When you're buying properties, look at stuff 100,000 or more, it starts to make sense. As you can see here, you get up there in multifamily, 700, 800, million plus, there starts to be some massive tax savings when you start getting into the higher end properties. All right, home office deduction. So next one's the home office deduction. Now, if you have an accountant that tells you not to take this, you need to talk to a different accountant as well. So there's a couple of things with the home office deduction. One, it's not a massive deduction, but it's still a deduction. It's still less money than you're giving to the IRS, because you've earned the money, you earned the right to keep it in your pocket by using the legal tax code. So the first thing with the home office deduction is you have to have a dedicated space within your home to qualify for the home office deduction. Sitting on your couch and working from home does not qualify as a home office. You have to have a dedicated space within your home. Now, the home office is interesting because years and years and years ago, the IRS, they used to get it. So basically what they would say is it's not typical for people years ago to have home offices. Most people went to work and then came home. So once we started to see like multi-level marketing companies, especially after COVID, right? A lot of people now, they're doing multi-level marketing. They had a home office. They started to see online businesses. People needed an office from home. So we see that more, then we see like a lot more like, real estate investing and professional investing, people like that need an office. So what's happened is over the last 20, 30, 40 years, 20 or 30 years, I should say, is, back then, most people had no home office because they would just go to work, come home. And so now everybody has a home office. So it's no longer a red flag like it might have been a decade, 2 decades, 3 decades ago. It's something that's very, very, very common. It's very typical for a person to have a home office. And if it's done right, now in order for it to be done right, though, you have to behave like a big business or an investor. So thinking, like I mentioned, you can't just sit on your couch and say, this is my home office. You have to have a set up space that and document and be able to show that this is my home office. Now, there's a couple of ways to determine how you value your the deduction of your home. So you have to have a set space. Now, the simplified option of deducting it is instead of you take the square footage of your space, multiply it by $5 per square feet. So if you have 300 square feet, multiply it by 5, you get a $1,500 deduction. That's the simple way of doing it. Take whatever space. If you have a 10 by 10 office, 5, that's 100 square feet by 5, that's a $500 deduction. Again, it's not a massive deduction, but why not take it? Especially as a real estate agent, you may come to an office, you may be working from home, you may be doing both, and that's fine. You can do both. You can have an office and have a home deduction. I have an office space here and I have a home office, so I deduct both. So I'm able to deduct my home office, but it has to be a dedicated space for it. So if you have a 300 square foot room, it's a $1,500 deduction. Then there's another way of doing it where you can deduct your mortgage, your interest, your taxes, your maintenance, your repairs, your insurance, your utilities, all of the other stuff, but it's way more complex. There's way more, and on average, you might deduct maybe $100 or $200 more than if you just take the straight line way of deducting it by $5 a square foot. So you're going to do a lot more and have to have way more documentation to not really offset the difference of the tax incentive that you're going to get. So typically just take $5 per square foot, deduct it by your square footage. That's your home office deduction. Now, that's important for a couple of reasons, not because it's a massive deduction, but here's the bigger reason why it's important. And why it's important is this, because of your vehicle deduction. Now, I'll talk about it in a minute. I'm going to go back to that. But let's say for a vehicle deduction right now, the standard mileage deduction for business travel, and all of you listening here as real estate agents, you can deduct your miles. They increased it in June to 62.5 cents because gas prices were through the roof. So they increased it 4 cents to finish out 2022. Now, a lot of people will ask me too, should I lease a vehicle or should I own? That depends on a couple of things. One, it depends on how many miles you drive. If you're a real estate agent that works with tons of buyers and you're putting 40, 30, 40, 35, 40, 50,000 miles a year in your car, most likely the mileage deduction is going to be the route to go. Now, if you're a person also that likes to hang on to your cars and wait and hold your car and own your car for 4, 5, 6, 7 years, the mileage deduction is the route to go. If you're somebody that likes having a payment and you want to lease new cars every 2 years or 3 years, well, then leasing might be a better option because in the lease now, we're not tracking mileage, but we're fully deducting the lease payment. We're deducting things like maintenance and fuel and everything like that. So you can get write-offs there. So if you're a person that likes to have new cars every couple of years, leasing and you're not driving thousands and tens of thousands of miles, maybe you're somebody that, I don't know, only services business in your area and you drive 10,000 miles a year or less. So you can maintain under what the lease payment or the lease mileage will give you. And you're okay with having a lease payment. Leasing might be the route for you. So you want a new car every couple of years, you're not driving a ton, leasing. If you are driving a lot and you like to hold your cars, or even if you like to get new cars every couple of years, but you're driving 30, 40,000 miles a year, the mileage deduction is most likely the way to go. Something else to keep in mind, something that's going away here in, I don't know what the date is, like 4 days or 3 days, is the 6,000 pound deduction at 100% deductible sale price. So right now, if you buy a vehicle with a gross weight over 6,000 pounds, we're talking like SUVs. If you buy an SUV that's over 6,000 pounds, you can deduct 100% of the sale price of that. It's a massive deduction right now. Next year, it's going to go to 80% of the sale price. The year after that, 60%, 40%. They're going to phase this deduction out over the next couple of years. So I don't recommend going and buying a car if you don't need it, just to have some tax savings. But if you, need a car, you've been thinking about a car, and you've been thinking about an SUV, now might be the time to go do it before the end of the year. If you can go buy one today or tomorrow, all right, get a 6,000 pound, you can deduct 100% of that purchase price off your tax income. It's a big savings. And it's something that's going to phase out. So next year it's 80%, which still would be a nice deduction. Just keep that in mind. I just did this a couple of weeks ago, bought a 6,000 pound vehicle for this exact reason. So if you need the tax write-offs, if you need a new vehicle, think about that as an option. Now, going back to the home office, this is why a home office is important, because with mileage deductions as well. So accountants have different guidelines and they're going to go differently on what they feel comfortable with deducting. You as a real estate agent, what they're going to deduct. Now, if you have a home office, your mileage deduction starts from the time you leave your home. So let's just say you didn't have a home office and you drove to the office every day and it was 20 miles to the office and 20 miles home. Well, you would not be able to count that 40-mile round trip mileage deduction every day. because it's just driving to and from the office. But if you have a home office, now what you're doing is you're leaving your home office and you're driving to your other office. You started work at your home. That is your start of your mileage deduction. And then you drove to your home office from your office. That is another deduction. So now you're deducting 90+% of your mileage. That's why the home office deduction is very important to set up a home office, because you're going to be, now let's just say you leave your home and you don't have a home office and you go to show property. Well, that commute to going to show homes is not counting, or to that listing appointment is not counting. But if you leave your home office and go to show homes or go to that listing appointment, all of that mileage is deductible, and going back home, all of that mileage is deductible. If you don't have a home office, it's not deductible. So I highly recommend setting up a space in your home to have a home office, so that way you can get this deduction. Very, very important. Next one is travel. So travel deduction. Now, how do we deduct travel? Can we deduct our trip to Disney, right? How do we deduct that? Well, there's a couple of things the guideline says. In order for it to be deductible, remember, it has to have a business purpose, right? It has to meet the 4 tests. Business purpose, it has to be ordinary, it has to be necessary, and it has to be documented. So is traveling to Disney World any of those 4, or all of those 4? The answer is no. If you're going to Disney World to take your kids on vacation, it's not a business expense, so you can't deduct it. Now, how could you make it a business expense? Well, let's say I'm going to Disney and I'm looking to buy investment properties in Florida. So I want to take my kids to Disney and I fly there on Friday. Well, now Saturday and Sunday aren't technically work days, so I have those as free days, taking my kids to Disney. Now Monday, I have to work over 4 hours per day in my business to be able to be classified as a business purpose for wanting to go there. So you have to work over 4 hours per workday, 4 hours or more per workday, in order for it to be considered a business purpose. This is also not work you bring with you. So you can't just bring work with you and say, you know what, I'm going to work while I'm here. It has to be a business purpose or reason for going there. So if I'm looking to buy Airbnbs in Florida, I have to show that I actually went and looked at Airbnbs for 4 hours per day on the days I was there, Monday through Friday, and be able to document that. Or let's just say I went to a seminar, which we're going to talk about in education here in a moment. If I'm going to Florida for a real estate seminar, well, that would be deductible because I'm spending more than 4 hours in a system essentially where it's necessary, it's a business, it's ordinary, I'm going there. So my travel could be documented. Now, what about a spouse? Can I deduct my spouse's income? So if I'm going to Florida to look for Airbnbs, and even if they're not part of the business, but let's say they work in the business or help me with the business, even though maybe they're not on the LLC, well, if they're helping and assisting in that, then I should by definition be able to deduct their airfare as well. So this is a tricky one where you have to be careful, but keep in mind that it's all about following the rules. Am I working 4 hours or more in the business in whatever I'm there for? Let's say I have an accountant, right, or a mastermind group. Well, I could deduct that travel because I'm going there for a specific reason and meeting with those people for over 4 hours. Like a lot of tax accountants, they'll have their tax seminars and they're literally like 3 or 4 days long or 5 days long, and they're 4 hours a day. So they can go there for 4 hours, go play and have fun after that, and that the whole trip is deductible and they still get to go benefit. So keep that in mind for travel, is that, can it be deductible? Yes, but it can't just be, hey, I'm going on vacation to go have fun. There has to be a business purpose to it. And you have to prove in the event of getting audited that you did do some form of business purpose for over 4 hours per day that you were there. Very important. All right, meals. This is one most people know about. So meals, pretty simple. With meals, how do we deduct it? Can I deduct my groceries? Well, no. Can I deduct my personal groceries? No. Can I deduct groceries where I'm buying for a company event? Yes, I can. Can I deduct, this is a big one, can I deduct meals with my spouse? If you're married, even if they don't work in your business, the answer is yes. If you're talking about business, let's just say you've got a spouse that doesn't care anything about your business, they just want to know how much money you're making so they know how much they can spend. You can deduct that because you're having a business meeting about that. Now, if you go out to dinner every single night, is that going to be believable? Probably not. it's probably not going to be believable that you're going out with your spouse every single night and having business conversations. But let's just say you have date night once a week. You can deduct that as long as you talk about your business and document on your receipts what you talked about. So again, it's all about, comes down to documentation. But let's just say every single week you go on a date night, you go to a steakhouse and you spend $150. All of a sudden now that is $600 a month in deductions that you can make because you're taking your spouse to dinner. It's something you're going to do anyway. You turned it into a business conversation at dinner. You documented your receipts. You saved your receipts. Well, that now becomes a business expense for meals. The same is true with deducting meals with your clients. You can take your clients out to lunch, to dinner, to events, to client events. Just make sure when you do it, you're documenting. And again, credit card statements are not a form of receipt or documentation in the eyes of the IRS. So this is where you have to make sure you're taking really good documentation. You're saving receipts. You're writing a note. Who did I go to lunch with? Who did I go to dinner with? What was the purpose for it? I would scan it in. I would save it. Have this stuff documented in the event of an audit. It's very important that you document everything you can. Questions on that? Let me know. Last one we've got here is education. So is education deductible? Maybe, maybe not. Now, if you're an employee of a company and you have no business, like you don't have your own business, and you're looking to do some form of, let's say like a real estate agent, an employee of a real estate office, and you do some form of training, is it deductible? The answer is no, because you don't have a business to deduct. So the IRS does not view you as an individual, as a business. So you have to have a business. So again, if I'm a real estate agent, I have a business, I have my real estate license, I have a business, I can deduct educational expenses provided there's a business purpose. If there's no business purpose, and let's just say I bought a novel that I like to read, I can't really deduct that because there's no business purpose there. Now, if I buy a book on real estate, or I buy a book on business or leadership, is there a business purpose for that? The answer is yes. If I go to a training seminar or conference, is there a business purpose? Yes, I can deduct that education. Like I do a mastermind 4 times a year. I deduct that as education. I'm able to deduct my travel as well because I'm spending more than 4 hours a day in the event there. And I'm literally there for that. Now, do I get to go out and like climb Camelback in Arizona, do some fun stuff like that? Absolutely. So I get a little bit of vacation out of it as well, but I'm able to deduct all of that because there's business purpose. It's necessary for my business in order to keep growing. It's ordinary, meaning it's something ordinary people do, and it's well documented in the event of an IRS. So my education can be deductible. What's important here is always label your education as continuing education. Don't label it as online classes or seminars. IRS likes to see continuing education. So of course you do 12 hours of continuing education every 2 years. That's tax deductible if you're paying for it. And any education you're doing, as long as it serves a business purpose, and think about that, is it business, is it ordinary, is it necessary, and is it documented, you should be able to deduct that. So these are simple things that we can do to deduct and offset our taxes. So I'm curious to see if anybody knew of any, like, did any of these stick out that maybe you didn't know about? That's all we have for the deductions here. Now, of course, there's way more, right? And we'll get into some of that at a later date on just like really oddball stuff that the government wants you to do and incentivizes you to do and offset your taxes that you don't even know about. But for us as real estate professionals, these are some of the biggest ones you can talk about, especially cost segregation. Cost segregation is a big one. I don't know if I've got a question here or, oh, here we go. Okay, let me see here. All right, so we've got a question here. Can you put 2 cars on your deductions? How do you prove you worked for 4 hours a day in your business? So can you put 2 hours a day or 2 cars? Yes, you can. Yes, you can deduct multiple cars on your deduction. So that's totally fine. Maybe you have in your business, you have partners, you have multiple people in it. Yes, you can deduct more than one vehicle. How do you prove? Has to be documented. So like one of the things I do is like the seminars, the conferences I go to, well, there's an itinerary. It's proven that I'm sitting there from 8 to whatever time, 5 o'clock. So I'm actually there like 8 hours a day. It's proven. If I'm going to Florida to look for Airbnbs, I have to be able to show and identify that I looked at a certain number of properties. Here's the time I spent looking at 6 properties that I'm looking to purchase. You know, on average, it took an hour on each property. That's 6 hours. So you just have to be able to prove it from that form that it is something that you're documenting, if that makes sense. You just have to have proof that I did go do these things. And I didn't just go on vacation and went to Disney World, right? Like that's not, I actually worked in my business and pushing my business forward. I met with people. If you have meetings, you have to prove that maybe I documented a calendar invite that I've met with this person. I met with this person, my accountant, for an hour in Florida. They live in Florida. I met an attorney that lives in Florida that I work with, things like that. I went to meet and network with other real estate agents, document the event. Here's my calendar invite. Here's my calendar notices. Keep all of that information documented. The more you can prove, the better. If a credit card statement are not acceptable by the IRS as a source of documentation, are regular bank statements acceptable? I would have it, yes, but the better you can get at saving receipts, the better off you're going to be. When it comes to the IRS, the more documentation you have, the better off you're going to be. So now if I can go to the IRS and I get audited and I can show them that I have credit card statements and bank statements, I've got my QuickBooks all lined out, and here's receipts as well, that audit should go pretty seamless. You know, if I go there and I got a shoebox full of receipts and I just say here, right? But if I have stuff scanned in, I've got things documented, I've got things lined up. That's why it's super important to be organized. And for a lot of new real estate agents, very, very important to not commingle funds. Like all of us are guilty of this when we first started. We use our personal checking account as our business checking account as well. Now that you have a real estate license, I would highly recommend, if you start making money, when you start making money, have a separate account. So set up a separate account for your business, and that's going to help you a lot, because then that real estate money goes into that business. You can put away for taxes. You can pay yourself a salary from that. But putting your money into your personal checking account is going to be very, very challenging, especially if you get audited. So make sure you set up different accounts. Let's see, the calendar invites and other such things that are documented. Do they need to be saved somewhere? Yes, I would save them somewhere. However you file it, right? So wherever you're, like, think about it. When you go to lunch and you save a receipt, take a picture of it, save it in a folder, save it online, save it in a paper file. However, yes, you need to save it. The answer is yes, but whatever your filing system is for saving it, keep in mind those carbon copy receipts. Like back when I used to do a lot of renovation stuff, a lot of flips, those Lowe's and Home Depot receipts, the stuff would wear off after a while. So like it was hard to even read the receipt, the carbon copy stuff. So keep that in mind as well, that like scan it in. I would get in the habit of like weekly scanning your receipts in or taking photos of them and saving them in a file somewhere. Just get in the habit. The more documentation you have, the better off you're going to be. Local banks, credit unions, do you recommend for business reasons? You know, to each their own, really. I use PNC. They're not local, but I use PNC just because I've got a good relationship with them. I do like using like local credit unions, Neighbors Credit Union. Some of the local banks in St. Louis are very good, and you can establish business relationships with them, especially as you start buying investment properties. Having a relationship with a credit union type bank or a local bank to St. Louis can help you. They have different incentives, they have different programs, they have more benefits to wanting to help local community people. So the more you can establish relationships with a local bank, the better off you're going to be, especially as you start getting into like borrowing against properties and using that money to leverage to buy more investment properties. So I would look at that. I don't really have a recommendation on any, but that's just something to keep in mind. I would just look and see who you like, who's got good fees, who's not charging you maybe for, like if you don't have a certain amount in your account, they're charging you a substantial amount of money. So make sure there's low fees and you can establish a good relationship. Is there any possible advantage tax on the first year of buying your home? Well, you get the mortgage deduction. So you get like the mortgage deduction stuff, but other than that, no, not really. Not that I know of anyway. It's more so on buying, and because again, keep in mind, IRS wants us to incentivize us in two ways: provide affordable housing to people and create jobs. So owning my personal house, I'm not going to get a massive tax advantage other than using the Augusta rule though. If I go use the Augusta rule to rent out my house 14 days, maybe I can offset $20,000, $30,000, $40,000 in taxes or less, just depending. But if I do a team event or a company event at my house once a month, and it's going to cost me $3,000 to do that team event at a Marriott or AC hotel right down the street, well, now all of a sudden that's whatever 14 times 3 is. I can't do math, but $42,000. So $42,000 tax savings. So that's a way to do it, but you also get the mortgage deduction stuff. Other than that, those are the only two I know for utilizing your personal home though for tax savings. Any other questions? All right, well, if not, I appreciate you guys all being on. Feel free, if you have questions, you think of stuff later, shoot me a text, shoot me an email, give me a call. Happy to answer. That's all I got. Thanks for being on, and we'll talk to you guys soon. Have a great day.